Welcome to the daily update, where I'll go over the action in the market for Friday, March 8th, and then we'll see how things look for Monday, March 11th. We had a pullback after a solid start. You could just kind of tell the market was not really wanting to go up. We had the employment situation report come out. The market kind of was indecisive right after it was released. The futures were gyrating around a little bit, not really sure. Did they want to go higher? Did they want to go lower? And then we saw that come over into the open of the cash session, and we saw an initial move up. In fact, we went all the way up to R2. That set the high for the day, and we spent most of the day then coming down. We went negative. We did close a little bit up off of the lows. So we're having to ask ourselves, is this just a pullback? A lot of the stocks that got hit on Friday were ones that have been doing really well lately. Or are we starting to see some kind of a reversal taking shape? It's too early to really answer that right now. For the time being, it looks like a pullback. But even reversals start off by looking like a pullback. We are in a period of weak seasonality that the market really hasn't been paying attention to. We've got some big economic reports coming out in the upcoming week that'll go over inflation and how retail sales are doing. And taken all together, is the market going to see that as positive and justify prices going higher? Or are we going to see a continuation of some profit taking? So let's go back and talk about what happened. Right at the open, we did have a gap higher open. Things started off really positively. But remember, it's the amateurs who open the market, it's the professionals who close the market. We were above R1 at 51.73, and then we hit resistance right at R2 at 51.88. As the day went on, we fell back from R2. We fell below R1. We actually went negative. We went below the unchanged level. We went below the daily pivot. And isn't that interesting? At the Van Halen crazy level of 51.50, that was the daily pivot for Friday's session. We even dropped below that. We fell below S1 at 51.35. We did find some support at 51.18, and we bounced back a little bit to the daily pivot, again, the crazy 51.50 level, and we closed back down near the daily low. So it was a profit-taking day, to say the least. We were down 0.65%, not a real big move on a percentage basis, but when you measure it from the high down to the low, it was a pretty wide day. But this is encouraging. It was below average with volume. To see a decline on below average volume, that's encouraging. We've been concerned that we've been going up on below average volume, but we didn't see a lot of buying or selling coming really flying into the picture. It just looked like a normal pullback to this point. We are still positive with our technicals. We've been able to work off some of this extreme positive nature that we developed after Wednesday's session and Thursday's session going into Friday's session. And in the upcoming week, it will be about inflation and interest rates. Is inflation a problem? We'll get CPI and PPI. What's the Fed going to do? Are they going to be able to lower rates at some point in 2024? We'll see if that scenario ends up changing. And we want to keep an eye on the geopolitical events. Some comments, mega caps and semiconductors. These have been the stocks that have just been going to the moon lately. They underperformed in Friday's session. So you had folks locking in some profits there. On a short-term basis, we still have our CCI 14 and 20 and our stochastics. Everything else has been taken off the list since yesterday's video. In the intermediate term, the Arun, and sometimes it can take a while for the Arun to move. It's still giving us an extreme positive reading. We're still keeping an eye on the oscillators, which they're turning a little more negative now, but they're still giving us really extreme high readings. And the bullish percent index, I neglected to put that on the list lately. We're above 70 with that. That's another really important indicator that we're keeping an eye on. The Sean trend meter did decline, but it's still extreme positive. And then our 10-period new high, new low study for the S&P, we're still extreme with the 150 and 200 period simple moving averages. So in the intermediate to long term, we haven't seen much of a change. Where we're seeing an initial change is in the short term, and that only stands to reason. We are still going with the same basic scenario. It looks like the Fed is done raising rates. They're probably going to cut rates at some point in 2024. We're just not quite sure when that's going to be. The dollar was down and interest rates were also down. We ended up being unchanged with the 10-year yield at 4.09%. So the dollar declining and interest rates, they've been a little more friendly this week. But then we saw week before last when stocks were going up as interest rates were going up. Usually they go in opposite directions. In this kind of an environment, they were down, but stocks ended up going down as well. We still have the yield curves that we're following that remain inverted. The general idea is when they go back to being normal, there's about a 5-month window that we look at to see, are we going to go into a recession? Are we not going to go into a recession? That's why we keep an eye on these inverted yield curves. Sentiment did drop. It had become rather extreme again, up at 75. With the down day, it dropped down to 71. Our trend is still positive, but the ADX is still weakening. It's still below its moving average. The green line is still on top. We're still in a trend, though, because we are above 20 with the ADX. With the down day, our bias is negative, and I've changed our momentum over to mixed to positive still because of the down day on Friday. We did have the biggest economic report of the month. We had non-farm payrolls that came out stronger than expected, and the market liked that. Hey, lots of jobs out there, 275,000, greater than the 195,000 that they thought were going to come out, and up from the 229,000 that we saw last time. Now, you'll notice that there's another number over here at the end. This was the number that we were given, 353,000, and everybody was all freaked out about that and thinking, wow, what a great employment situation we're in. Well, look at how they revised it down from 353 million to 229,000. That's quite a revision. And so we're keeping an eye not only on the headline number that we get, we're looking at how they're changing previous numbers to see if there's any weakness starting to come through there. Also, non-farm private payrolls came in much higher than expected at 223,000. They expected 153,000. We also saw a really big revision here. We did initially hear that they had 317,000 new jobs. It was revised down to 177,000 new jobs. The average hourly earnings came in weaker than expected, and this, I think, is what the market really picked up on. They like that it's going up and that people are earning more, but it came in less than what they were expecting at 0.1%. They expected it to be up 0.3%, and it's down from the 0.5% that we saw last time. The unemployment rate actually went up. You look at these strong numbers up on top here, and you're like, how can the unemployment rate go up? Well, it's kind of a manipulated figure that they do. And however they crunched the numbers, they came to 3.9%, where they expected 3.7%, and that's what we saw for the last couple of months. The average work week, that was unchanged, and it came in as expected at 34.3. The market also liked that too, even though it ticked up from 34.2 that we saw last time. That had already been baked into the market, and so people aren't working a lot more right now. Here are some charts, and I don't show you the job charts from briefing.com because of the COVID plunge. Those charts are almost useless. But here is the unemployment rate, where it is ticking up to 3.9%. Still very low historically. Here's a more of a blow-up look, comparing it to the initial jobless claims. That's the red line that we received on Thursday. We have the blue line, which are continuing claims, and there's a little bit of a lag here with the unemployment rate, showing just how these are all doing on the same chart. Here are the hourly earnings, where they did tick down a little bit, but they're still above 4%. And non-farm payroll changes month over month, where we did see an increase. And they really pulled back the number from the previous month. Here's just some charts I ran across from Isabel Net. It says new highs happen in clusters. And you can go back all the way to 1957 and see that usually when we make a new high and then another new high, that tends to happen all within a group. Not sure this is really all that helpful. It's just kind of interesting to look at. And then looking at the number of times that stocks have increased 25% in a 5-month period, that's happened 10 times since the 1930s. And of course, all of you remember October 1938, of course. And then other times that this has happened. Again, I'm not so sure this is really all that helpful. This is really more for information. I didn't find any Twitter charts of interest. I haven't spent a lot of time on there lately. I'll see what I find over the weekend. Here's our intraday chart where we did get off to a really good start. We went above R1 and we hit resistance right up here at R2. Then we started to pull back. We came down. We actually went negative. We went below the 5150 crazy level, according to Van Halen. We came down below S1. We didn't quite make it down to S2 before bouncing back up. Then we hit resistance at the crazy 5150 level. And then we ended up closing not too far off of the low. Here's our intraday chart where we were seeing a little bit of strength in the initial overnight session. That picked up when Europe opened, but then we started to see a real trailing off here. But then after the report came out, we saw some strength, and then the reaction after the market opened, the high that we set during the cash session, and then the decline, and we're trailing off just a little bit as the markets close for the weekend. And this is another concern. We're seeing the green line going down a lot. Green. Okay, that's a blue line. We're seeing the blue line going down a lot more than the red line when we compare growth to value. Now, these are on different scales, but we like it when the blue line is above the red line and it's continuing to decline there. We're also seeing a decline with our S&P 500 growth to value ratio intraday. It had been showing some improvement. It pulled back in Friday's session. This is a little bit of a concern. Our end of day charts, growth was down over 1%, where value ended up being positive. Growth was down more with the mid caps and also with the small caps. So we saw not a good day for growth on all the different indexes, but we're still hanging in there. When we look at our end of day chart, when we look at small cap growth to value, even though it pulled back, we're still seeing some improvement. We're not seeing a real improvement with the index, but internally we are seeing some improvement here. And the mid caps, which did come off of setting an all-time high, it's the small caps that still have yet to do that. We're seeing a little bit of weakness here with the growth to value ratio, but longer term, it still is continuing to be in an uptrend. Here's S&P growth to value, again, pulling back, showing some weakness, but still in a longer term uptrend. And discretionary, this is another area of disappointment. We look at the ratio on the bottom where when you compare discretionary to staples, it was pretty much flat and it's in an uptrend, but we want to see this really breaking out for this to turn more positive. One thing to note here, when we look at the equal weight ETFs, discretionary is in an uptrend. We're starting to see a death cross here when we look at staples with this particular ETF. Looking at our trend, we're still below the moving average. The ADX is still above 20. So we're in a trending environment, but it's a weakening trend. We're in a positive trending environment because the green line's on top and it is coming down after getting up close to that 40 level. We're also trying to turn up a little bit here, but not quite above the moving average in the short term. The green line is still on top. So we are in a weakening, positive trending environment. We did see a drop off in volume, and on a down day, that's rather encouraging. Looking at sentiment, not a real big change with the Ulcer Index. We did go up since we had a down day. When we look at the VIX of the line chart as well as the bar chart, we're still keeping an eye on this too. We're setting a series of higher highs with the VIX on both charts here. And since we ended up closing lower, we also saw volatility really picking up as prices were going down. We shot up with the line chart, the bar chart and the line chart, and both are now above the moving averages. And the MACD, the momentum of the MACD is starting to turn back up as well, as the MACD overall has been going higher. The equity put call ratio still declined, though, on a daily basis. And when we look at our 5 period, it's continuing to go down. So that is still positive. The advanced decline line is still hanging in there. We're pretty much flat when we look at the advanced decline line based on price and volume. So far, the internals of the S&P 500 are hanging in there. We're rolling over a little bit with our new highs, new lows, and we're starting to turn down with our 10 period, even though we're seeing new highs really outnumbering new lows. And when we saw that thrust up at the open, that really was when most of the new highs were generated. We're still positive with our advanced decline ratio, and this is making a series of higher lows as we've been going up, so that's positive. Accumulation distribution did decline, but it's still above the moving average. We are seeing a little bit of weakness here. This is another smart money indicator. The Chaikin money flow it's still positive, but it has been declining. And we're starting to go down, but we're still just barely positive with the Chaikin oscillator. The advanced decline line for the NYSE, it held up pretty well. In fact, it ended up being up on the day, but we're not above where we were back in 2021. When we look at NYSE common stock, this is looking a little better now, where we've been breaking out above previous highs based on price and volume. So that's still encouraging. With our advanced decline line studies, the NYSE common stock is still looking fairly strong. Same with the S&P. We turned down a bit with the mid caps. We're still lagging behind when it comes to the small caps. Here's our short-term trend that we're looking at, and sometimes I call it a long-term trend. I just, whatever you want to call it. But we did close down below that. So that's the first line of support. We did break through that. Now, we broke through that earlier in the week, and then we were able to recapture that. The next logical line of support is going to be the 20-period moving averages, and that's what we'll be watching. Down below, you can see where volume did drop to below average. Here is the 20-period moving averages. We're still above them. We didn't get down to this level when we saw the pullback earlier in the week. We got that from the QQQs, or the NASDAQ 100. We'll be seeing if there's more weakness, are we going to come down and actually test this moving average? The CCI 14, it did drop, but it's still looking extreme positive, and the CCI 20 is also positive, extremely so. We're flattening out a little bit with our 20, 50, and 200-period moving averages. The longer-term ones are still looking okay and not quite extreme positive yet. We did come down with the force index, but we're still positive there. We're no longer extreme in the short term with those stochastics. We actually turned up and are extreme positive in the intermediate term. We're rolling over, but still extreme positive in the long term. And we're no longer extreme with our standard deviations chart. We did decline. We're still above the midpoint. We're just on the border between the +1 and +2 standard deviations channel. Intermediate term, we are declining, but we're still positive with the balance of power. We're still looking positive with the go, no-go system with darker blue bars. We did decline, but we're still above the midpoint with our highest high value. And we switch back over to a darker shade of blue with the TTM squeeze. We've been flattening out quite a bit with the ease of movement. Now, this tries to measure the path of least resistance. It doesn't really take volume into account per se. It just says, or whatever this is measuring, is it more inclined to go up or go down? Well, right now, it's more inclined to go sideways. Here's our Arun indicator, which really didn't change. We have the green line on top. That's showing the buyers are still in control. Sellers are dropping off. That's why we're getting a really high reading with our oscillator, and you could make a case that it's extreme positive. We turned down a little bit with the S&P McClellan oscillator, but we're still above zero. At the same time, in the bigger picture, we're watching this negative divergence. Also, we continue to be positive with the summation index based on price and volume is looking a little bit better. But longer term, we're also watching this negative divergence. Same thing here. The NYSE McClellan oscillator turned down a little bit, but is still above zero, longer term negative divergence. But we're still going up with the summation index based on price and volume is looking better here. So this is encouraging. We're seeing it across the NYSE, and we're seeing it in the S&P 500. The Swenlin trading oscillator was pretty much flat based on price. It actually turned down a little based on volume, but we're still above zero. And the oscillators are just chopping along after giving us extreme positive readings. But when you look at the PMO based on price and volume, they still continue to be positive. We saw a little bit of a decline with the PMOs that are rising. We're flattening out with the buy signals. We're still continuing to go up with the PMOs that are above zero. We switched over to neutral with the Elder's Impulse system. We're still positive with the parabolic SAR. The slope is just kind of chopping around sideways now, pretty much on top of its moving average. And the Sean trend meter, that's usually in a different place here. It's looking a little bit extreme positive still. Here is our oscillators, where we're still getting really high readings, but they've really been going flat lately. We're still above all the plotted moving averages here. We'll be watching these 20-period moving averages. And here's the bullish percent index. We're above 70, so that's an extreme positive reading, but we actually went up. That thrust up at the opening on Friday did generate some new bullish percent index positive signals. So that's still looking good for right now. We did go up with the NYSE bullish percent index, but we declined with the NASDAQ 100 bullish percent index. We're kind of going sideways now with the money flow index, but we're still above 50. The ultimate oscillator is declining, but also still above 50. The vortex, this has been causing some concern. We're seeing a series of lower highs here. The green line is still on top, so we're positive, but this is really kind of fading off into the sunset, possibly. We're still looking positive with our RSI. We did decline with the 14 and the 9 period, but we're still above 50. On balance volume did come down, but we're still looking longer term positive there. We turned down just a little bit with the stocks above their 20 period moving averages inside the S&P. This has been showing some improvement. We're still concerned about this possible negative divergence in the shorter term. We are showing some improvement though with the 200-day. Even with the down day, we saw this go up. So this is starting to negate the longer term negative divergence that we've been seeing. We're still seeing a negative divergence with the 50 period moving average study, but it is showing an improvement. The Copic curve might be a little bit above the moving average now. We're really flatlining with a lot of these. Oh, here's the Sean trend meter again, in case you didn't catch it the first time. I put a chart in the wrong place. We're still looking positive with the Heiken Ashi chart. We're still positive with the Kigi chart. It turned to black and is pointing up. The Renko is still looking positive, and the 3-line break is positive. So not a lot of technical damage as far as our different trend measuring tools that we use are really being picked up, at least yet. This is one, there's no new signal here, but this is flashing kind of a warning sign. We're just skyrocketing up with X's here, and this is a long top up right now, like a long, tall woman in a black dress or something. So it's just cautioning us that we usually don't see spikes up this quick. And that's why we've seen over a 20% gain in 5 months. The point and figure chart's going, hey, wait a minute here. That's we don't usually see that. I get kind of freaked out when I see those things because we're going up pretty far, pretty fast. Longer term, even though this is a shorter term chart, we did drop below the trend line here. So we're down below that. This level of support has now been broken. The next level will be the 20 period moving averages. We're coming up in the upcoming week. On Thursday, we will get a new cycle with the 50-day cycles. Again, I don't base decisions around this. I use this more for information. Sometimes it ends up marking a top or a bottom. Other times it marks a continuation. Here's the long-term chart. We're still above that 5150 level. Or let me take that back. We're still above the 5111 level. I can get all excited about the 5150 thing. So that is still holding up for right now. We haven't dropped below this longer-term pivot point yet. The longer we can stay above this, if we do continue to go down, the more likely that is to act as support. Longer term, we're still extreme with the 150 and 200 period moving averages. We're still positive, though, with the Keller market model across all the different indexes. We saw a lot of blue to start off the day, or green. Then we saw a lot of red to end the day, and that's pretty much how the day unfolded. The equal weight is still hanging in there and actually doing a little bit better than the S&P 500 weighted index. So we came down with the ratio. That means the mega caps underperformed. When this is going up, the mega caps are outperforming. This is still a concern. We're still seeing the transports to S&P 500 ratio continue to decline. That is longer term negative. And I think I said positive in yesterday's video. But we need the transports to be doing better. And at some point, the market may decide that it needs to deal with that, but it's not really dealing with it right now. The Dow came right back down to about this pivot point, just a little bit below it. Ended up being down slightly on Friday. We switched from being neutral over to negative with the Elders Impulse system and looking at the diamonds. We came right up to this R1 level and then fell back with the NASDAQ. And the NASDAQ 100 also hit this R1 level. What I've found over the last couple of years is these pivot points tend to be pretty significant with the NASDAQ and the NASDAQ 100. So that's why I put them on here, and we really want to pay attention to these. And that did provide some overhead resistance, at least for right now. We went from being positive to neutral with the QQQs with the Elders Impulse system, and we're still kind of looking more negative now with the momentum for the NASDAQ 100. We have an up day, and this looks a little more positive. We have a down day, it looks a little bit more negative. Now, in the bigger context, we're still looking at this negative divergence, and we're also seeing possibly a shorter-term negative divergence as price has been going up. So we just want to be aware of this. Here's the QQQs, where earlier in the week, we did come down and found some support off the 20 period moving average. We did not hit that on Friday. We'll be watching this level if we continue to fall to see if it provides support again. This is longer term, looking at the NASDAQ 100 to Dow ratio or mega cap growth to value, where we came down with this ratio, but we're still pretty much right where the red line is at. This is a long-term chart. I mean, this goes back to the year 2000. So, I mean, we're talking, 23, 24 years there. But this is what the bearish folks are really picking up on, thinking that we're going to hit this and then just go in the toilet after that. And it may work out that way. We're just watching this on a day in and day out basis to see, does it look like that's what is developing? And for right now, no, it doesn't look that way. The small caps ended up being down slightly and have pretty much been chopping sideways. We've gone from being positive back over to neutral with the small caps when looking at the Elders Impulse system. The Russell, again, started off pretty good, but didn't end all that well. Still looking a little bit better when we look at the chart taken over the last number of trading days. The RSI is still above 50. The momentum is still positive, and the longer-term trend is still positive there. The mid caps they set an intraday high, but then they came down and closed right at this R1 pivot level. They've gone from being positive over to neutral with the Elders Impulse system for the mid caps. This is another ratio. The QQQs, the NASDAQ 100 ratio to the IWM, which is the Russell 2000 small caps. This is coming down with a little bit more force now. As the QQQs, you would think this would be going up because they're outperforming, and we're doing a ratio based on this, but it is showing some weakness currently. Also keeping an eye on Google, it did bounce up off its 200-day moving average. That is somewhat positive. Apple is still below both of these moving averages, and in a few days, if price doesn't really improve, we might see a death cross with its more intermediate term trend. We're already in a downtrend with Tesla, and it's below both of the moving averages. These are 3 of the 7 Magnificent 7 stocks. The FANG index ended up being down, but it's pretty much been chopping sideways lately. It's still in a longer term uptrend. The financial sector ended up being up, and it's in a more solid uptrend. New York Community Bank, we're just keeping an eye on this. After there was a huge influx of $1 billion, that helped the stock price to bounce back up, but it pulled back in Friday's session. The dollar has been pulling back, which has been giving some support to stocks. We did end up being unchanged with the 10-year yield. We were also unchanged when we look at the 10-year based on price. And then looking at our growth to value, not seeing an awful lot of strength here. The Qs to S&P starting to drop further below the moving average. Discretionary turned up a little bit, but we're still below a declining moving average. And we saw a little bit of weakness here when we compared large cap growth with large cap value. So the growth to value ratios with the large caps are showing some weakness, still above the moving average, but declined with the mid caps, and still looking even a little bit better with the small caps. So that could be somewhat encouraging. We're still looking positive with our 5-day moving average of the highs minus the lows across the broad market. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. So what's our outlook for Monday? We're positive, and as of right now, it looks like we're pulling back. But it was on lower volume, and that could be encouraging. We're still above that overhead resistance at the 5111 level, and we're still dealing with what historically has been a weak season. However, for Monday, it's the most positive day of the week, and we do have positive seasonality just from Monday's session. But it's like the market's been doing the opposite of what historical seasonality has been lately. We're not going to have any economic reports on Monday. We want to keep an eye on all the crazy things going on in the world, but the market just doesn't seem to be all that bothered by any of them currently. Here's the calendar. No reports on Monday. We're going to get CPI on Tuesday, and this is strange. We're going to get PPI and retail sales on Thursday. Usually they're a day apart from each other. This time they're coming out on the same day. We're going to get industrial production and capacity utilization on Friday. I personally think that's a more important one. And we're going to get consumer sentiment on Friday as well. Here's just a look at the whole economic calendar with the forecast and what their previous readings were. I didn't highlight anything because we don't have anything happening for Monday. Seasonally, we are positive with the Dow and S&P, where we're neutral to positive with the NASDAQ. And we're coming into options expiration week, where historically, we tend to be up 66% of the time and down 34% of the time. So we do have some positive seasonality going on with that. We will be on the 7th trading day of the month, where we do see some potential positive seasonality there. But when you take this in a little bigger picture, we might be seeing some of this little bounce in here, but the markets have not really been paying attention to this lately. Also, when the sitting president is running for re-election, we might see some continued weak seasonality. Monday is the best day of the week when we compare it to 2023. And then Tom Bowley, we're starting to come out of this period now where we might be getting into a bit of a bounce here, according to his research. So our warning signs, we're still keeping an eye on growth. It's hanging in there, but not really strong, especially when you look at it for the S&P. We still have our whole list of negative divergences, and we're keeping an eye on those. Now, if we see some improvements along the way, these negative divergences could go away. But for right now, they're still there, and we're still in a period of historical weak seasonality. Positive signs, we're still going up with our 5-period equity put call ratio. The parabolic SAR is positive. The Copic curve, it's right on top of its moving average. The vortex, it's still positive, but you remember it's making a series of lower highs, and it's really kind of fading right now. Small and mid-cap growth continues to be positive, and the financial sector is positive. So our conclusion, for right now, we're still positive. It looks like a pullback. It was on lower volume. We're still above that overhead resistance at 51.11, but we are dealing with longer-term historical weak seasonality, but it looks pretty good for a Monday session. In the short term, watching pretty much those same things. In the intermediate term, we are still dealing with some extreme positive readings, but we still are above that overhead resistance. And I'm still calling it resistance. We haven't been above it long enough to call it support. Long term, we are overbought with our 150 and 200 period moving averages. Thank you. I really hope you have a great weekend, and I will talk to you in the next video.